you on the map. This is Ron Costa, broadcasting live in the Mappable USA studios in Las Vegas, Nevada. And folks, we're going to continue on a conversation we had about a week ago on a great guest. We're going to talk about Regulation A. It's going to be a great podcast for both Reg A issuers and Reg A investors alike. So if you're one of those two, sit back, grab a cup of coffee, and we're going to get you some really good information today. And in order to do that, let us introduce Vicky Hutchmala from the QOZ Marketplace. Vicky, how you doing today?
I'm doing great, Ron. I'm doing really good, and I'm very happy because it's cooling down in Vegas, and now we can enjoy the reason why we all live here, because the weather is perfect now.
No question, and I just got to tell you, I just finished off with one of the best lattes I've made in a long time, so I'm really psyched about this. I got a lot of energy today to do this podcast. So,
all right, and plus we've got a great guest again. We talked to him before, but we're going to expand our conversation, so we should get started.
Yep, let's do that. Let's introduce Mike Brette. Mike is the CEO of Small Cap Equity Advisors. You guys know him. He's been on the show many times. Mike, how you doing today?
I'm doing well. Thanks for the opportunity.
Absolutely. We love to have you on. Every time you're on, you give us some great information. People are like, when are you going to bring this guy back again? So here we go. You're back.
Good.
And, Mike, I like to start every show with just really quickly, let's go over your background in case people have not heard our previous episodes with you. Can you just go over, what you do and how you got to be where you are over at Small Cap?
Yeah, sure. I've got my doctorate degree in law, my Juris Doctor, for 42 years. I've published 2 books that are still available on Amazon.com. One is called Raising Capital for Your Business, and the other one, which has a 5-star review, is called Asset Protection Planning. They've been out a number of years, but they're still ring true today, and I'm doing a 3rd edition for Raising Capital for Your Business, a new book coming out in about 8 or 9 months. It should be available on Amazon. But I've taken, in my 25-year career, I've taken a number of companies public, and I've helped them raise capital, helped them build their shareholder base. I do a lot of road shows, face-to-face road shows on the East Coast and here on the West Coast to introduce companies to investment banks and broker-dealers, family offices, retail investors. And recently, with the crowdfunding coming in, equity crowdfunding, 506C private placements, and Reg A plus offerings under the Jobs Act, which allows small companies to advertise, market, and promote to raise capital. My partners and I have kind of carved out a niche in that space as well. So, again, I've got 25 years experience dealing with small cap public companies, and taking private companies public, and looking forward to doing more deals.
Yeah, the last time you were on, we talked about the debt spiral and how a lot of these people who are looking to access capital markets really may not be as rosy as they want it to be. So your new fund, we talked about, solves that issue. But today we get into a little bit more about how to take these companies public and what happens after trading begins and items like that. So maybe we can expand upon that today.
Sure, absolutely. What's happened over the years? Companies get sold a bill of goods by some shell broker. They get on the phone with them and they say, "Look, I got a shell. Buy it from me for $200,000, $300,000, $400,000, and I can raise $10 million for you." Well, that turns out not to be true. And so what happens is these companies do these deals. The shell broker keeps all the free trading stock. When the company starts trading, then the shell broker and his people start selling their free trading stock into the market, push the stock price down, and the company's sitting there with no free trading stock to raise capital. So they're stuck. And so what they've had to rely on over the years is these toxic lenders that will come in and, they'll do these floorless convertible notes that have tremendous toxic elements to it that end up destroying the company as well as shareholder value. I mean, I've seen in my career, companies go from $5 down to a penny in about 9 months just because of the toxic elements involved. So what my partners and I have come up with is using the Reg A Plus as a method to take the company public. So we bypass the reverse merger. There's no $300,000-$400,000 involved in buying a shell. We have our clients do a Reg A Plus offering, filing with the SEC on Form 1A, and then we simultaneously prepare paperwork to get the company listed on OTC markets or on NASDAQ if it qualifies, so that when the SEC qualifies the Reg A Plus offering, they're trading on the OTC markets or NASDAQ. So we've taken them public with the Reg A, and then once they're trading, we can come in, my partners and I can come in with our fund and be the lead investor. So now the company has gone public, and they can secure capital that's not toxic through our fund. So that's kind of what my partners and I have come up with. We've been working on it now for about 9 months, and we finally put it all together in the last few months, and we've got a number of deals. In fact, that's why I was almost late getting on this interview. We were on a call with a securities lawyer out of Washington, D.C. that has a number of clients that they have Reg A Plus offerings for them, and they need financing, and they need market support. So we fill a good niche out there now where hopefully we can save some of these companies.
Are companies still doing reverse mergers?
They're not doing it as much as they used to in the past. The SEC and FINRA is the agency that gives you a stock symbol. Once you file the Form 15C211 or have a broker-dealer file it, then you get your stock symbol. Well, FINRA and the SEC, if they recognize that it's a reverse merger, I've seen FINRA hold up issuing a trading symbol. I've seen them hold it up for 8 or 9 months. So wow. There has been kind of a backlash in it. And secondly, NASDAQ doesn't take any companies that have done reverse mergers. They avoid it like the plague anymore. And the only way they'll do it is if you've got like 2 to 3 years of seasoning under your belt and different qualifications that they require. So reverse mergers, some are still doing it, but there's just better ways of going public than spending all that money with a shell. And then you don't know what kind of problems you're buying with the shell. I've seen deals in my career where there's old shareholder lawsuits that are out there that the new company doesn't find out about, and as soon as they start trading and issuing press releases and doing really well, here comes the lawsuits. And then they got to battle the lawsuits instead of running the company. So I'm not a big fan of reverse mergers anymore. I did them 15 years ago, 20 years ago, but lately I'm sticking with the Reg A Plus.
What about these SPACs, these special purpose acquisition companies? Will your Reg A strategy work for those guys too?
Yes, it'll work with them. But most of them with a SPAC, they raise their money in advance before they really start trading. So usually they're set up by investment banks, like the Morgan Stanleys and the bigger banks that put these deals together. They fund them right from the get-go, and then when they start trading, the SPAC goes out looking for an acquisition. That's why it's called a special purpose acquisition. So they already have their money, but if they need to raise additional follow-on money, yes, we could do a Reg A, and then once that's qualified, we can come in as an investor.
Yeah, that's pretty interesting. That's all, because there's a lot of companies out there. I know somebody actually does a whole trade show on just SPAC opportunities.
Yeah.
And I was wondering if they were as popular as they were years ago, but
they've come back quite a bit. They lost favor over the last, I'd say, 10 years. They kind of fell out of favor, but within the last, actually since this pandemic, and just prior to the pandemic, the SPACs really took a resurgence, and there's been, I don't know, at least a dozen or more that have been completed, and they're doing really well.
Yeah, so
the pandemic sure has done a lot to change the face of business in ways nobody thought.
Yeah, that's true. I miss the meeting face-to-face with clients and doing road shows and, getting deals done, and now you got to sit at your desk and use a computer or just talk on the phone. I just don't like it, but it's just the way it is for now.
Yeah. And you know what? There's nothing more important in business than shaking somebody's hand, because you can tell a whole lot by a handshake that you can't tell by talking to that person, and that's gone now.
Yeah. It'll come back, but probably not till the end of next year. But yeah.
Yeah. Okay. Well, let's talk about something from a issuer perspective. Okay. Let's say I'm an issuer, and Mike, I give you a call and say, I want to go public. What are the questions that you ask these people when they say that to you? Because obviously a lot of these people don't understand the intricacies involved and things that they have to do, reporting requirements, things like that. What do you tell somebody who just comes up and says that, and how do you get that conversation started?
Yeah, good point. My first question is, why do you want to go public? If they come out and say, look, we want to go public, my question is why? And I want to wait to hear that answer, because there's only one reason to go public, and that's to raise money. If they give me an answer other than that, then they really shouldn't be going public. But what we look for, aside from that, what we look for is a company that has at least an operating history of 2 years, that has audited financial statements, and that has at least $2 million or more in revenue. We don't. I mean, I get calls all the time from startups that are pre-revenue. They want to go public because they heard, again, somebody talked to them about a shell. We can raise a lot of money. We can all be wealthy. They buy into that scenario. So, I want to make sure they got a strong team. Has anybody on your team been involved with a publicly traded company? Have they been an officer, a director, a board member? And if not, then we try to work with them to get seasoned management in place, because that's critical, that they have a seasoned management team that knows how to run a public company, accept the responsibility of dealing with shareholders, be available for conference calls for bankers and shareholders, and be responsive. A lot of them just don't. And usually you find that out in advance, because the company avoids taking phone calls and things of that nature. Then well, if they're acting like that now as a private company, as a public company, it'll be even worse. Then we look for an industry that's growing, that's really gaining some traction. And like healthcare, for instance, the industry has always been important, but nothing like it is now with this pandemic. Health-related stocks, pharmaceuticals, anything dealing with software or anything health to make things easier, cheaper, and less expensive is really hot now to take public. And so we look for products and services that have broad appeal to a broad audience, that have real value. And then the last thing is we want to see some barriers to entry. In other words, what do you have that's so special that nobody else can get in and take their company public? What do you have? Do you have intellectual property? Do you have patents on your processes? Something that would prevent other companies from coming in right away. This way it gives this company some time to get some traction, to get their products to market or whatever they're doing. So those are some of the elements we look for when we're taking a private company public.
All right, so Mike, there's a lot of companies out there that want to use Reg A, not necessarily to go on like an OTC or a New York Stock Exchange, right? What are some of the ideas behind them? Like, why don't they just go a regular Reg A, like a CF or something like that, or maybe they don't want to go public?
Good point. Good question. You don't have to go public if you do a Reg A. You don't have to go public and get listed on OTC or a major exchange. You can stay private. We like the model of taking a company public with Reg A, because that's how we can supply capital to them out of our fund. We can't fund a private company. We can only fund a public company. Now, having said that, there's differences between a crowd fund, like a CF crowdfunding, a 506C private placement, and a Reg A offering. And I'll just give you a couple of the pros and cons on each one. With a 506C private placement, the stock that investors are buying out of that is restricted for 12 months, which means they can't sell it, trade it, hypothecate it. They can't do anything with it for 12 months. And the only way they can do it after the 12 month is if a registration statement is filed. So that's a drawback right there for some investors. They like the liquidity of a public company. Now with a 506c private placement, you can only take investment capital from accredited investors. And you have to take the extra steps to verify that they are accredited, which means you've got to get copies of tax returns, bank statements, letters from their attorney and their CPA attesting to the fact that they're accredited. With Reg A Plus, you can take investment capital from accredited and non-accredited investors. The stock that the investors buy, it's free trading, which means if you want to sell it to your brother-in-law or do something else with it, you can, because it's a free trading stock. Whether you get listed on an exchange or not, it's still free trading. And like I said, you can take capital from accredited and non-accredited. With a regular, like you mentioned, the crowdfunding, like a CF crowdfunding, that's really used for some companies that are trying to raise small amounts of money, like $200,000, $300,000, $400,000 as a seed capital. And again, you're limited on the investors what they get in return. They're getting private restricted stock that they can't do anything with unless you go public at some point in time or somebody buys you out. So each one of the crowdfunding, 506c, and Reg A, they all have their benefits and their disadvantages. You as a company, along with our help, we kind of help you navigate which one might be better for you at this point in time. Now, I have some clients that do a 506c private placement in order to raise some capital to do a Reg A and eventually get listed. You can do those steps as well. So you don't necessarily have to be a publicly traded company if you use Reg A. It's usually a good move because, again, you give some liquidity to your shareholders that buy in early in the company.
Yeah, that's absolutely right. And then same idea, I guess, for OTC, NASDAQ, New York Stock Exchange. You obviously want to start somewhere, right? So is a strategy to start, let's say, OTC and then move upward as you get bigger, or do people just stay on one area and just kind of let it trade?
Yeah, that's a good question, too. Most companies don't qualify to go directly to NASDAQ. NASDAQ has some stringent financial requirements as far as your financial operating history for the last 3 years. You have to have been operating as a profit. You have to have $15 million. Your stock has to be worth $15 million in the open market. You have to have 3 market makers. There's a whole list of requirements to get on a major exchange like NASDAQ that a lot of them don't qualify for. So what we recommend in some cases is start with OTC markets. Get some legs, get some traction, get investment banks and small cap investors aware of who you are, where you're going, and what you're doing. Establish a market for your securities, and then try to qualify to get up on a major exchange as quickly as possible. And usually that's in 12 to 24 months.
Okay, so now let's say I'm an issuer now, and I'm sold on the Reg A concept. Do I have to bring my own lawyers and accountants and auditors, et cetera, to the table for this kind of thing, or how does that work too? Because you got to pay these guys too, right? There's expenses involved. Yeah,
true. But no, I mean, we have our own securities lawyers that are part of our team, as well as CPAs that can do the audits. We have the transfer agents that we can bring in. We like working with V-Stock Transfer out of New York, Seth Farberman. He's a great guy.
I love those guys.
Yeah, and I have a lot of my clients with him. So we can be a one-stop shop for a company. We can do the legal, we can do the accounting, the audits, we can get them listed, and we can finance them once they're trading. Or if they have their own securities lawyer and they have their own auditors, they're welcome to do all that and just come to us with a finished prospectus, and we can take it from there.
Is there a time frame?
It sounds as though, it sounds obviously that raising capital is expensive. It's not easy, You have to know what you're doing and why you're doing it, and do due diligence in order to be successful. If you don't do that, then you're already done before you get started. So why should people come to you and your company, Brette, as opposed to anyone else? Why do you have the best service to make all of this happen for somebody?
That's a very good question. And where our benefit, our value lies in the deal is the fact that we're direct investors. So anybody, I use that phrase anybody, but qualified people can take a client public, not just us. But as I said earlier in this interview, the ultimate goal of going public is to raise capital. So if you come with us and let us take you public, we can also be the lead investor once you start trading. The drawback with other people, most lawyers, all they do is the paperwork, and accountants do paperwork, and then it's like you're on your own. Now, all right, we got you public, goodbye. Well, we don't stop there with getting a company public and getting them a stock symbol. We actually give them the capital that they need to succeed. So that's what differentiates our company, our service from other people. We're a one-stop shop for everything, including the capital. But we're not cheap.
Oh, excellent.
But we're not cheap either. Reg A, the paperwork, the legal work for a Reg A, our attorneys charge around $25,000. But they'll take half of that down, and the other half they'll take when the company starts trading. Same thing with the auditors. They work with us, and they give our clients a good price. We always tell clients, if you're doing a Reg A, again, whether you go public or you stay private, if you're doing a Reg A, figure about 7% of the money you're going to have to raise is what you're going to have to budget for the process. In other words, if you're trying to raise $20 million, it's going to cost you 10% of that, or $2 million, or 5 to 7%, depending upon where your company is in its life cycle right now. So we kind of budget that for clients.
Yeah.
Well, that's what they always say. You need to spend money to make money, and you need to go to the right people to spend that money. Otherwise, the relative ignorance of what you don't know is why people get sucked in by the toxic lenders, because they don't know the difference between a good company like yours and just somebody who's going to take advantage of you because you don't know any better.
Yeah, good point. And that's when these companies go public for the wrong reason and they find out they can't raise any capital, that's when the toxic lenders, they're like vultures. They start preying on these companies, and they know you need a quick $100,000 to keep the doors open, to make payroll, to do whatever, and your back is against the wall. You got to take the financing or you're going to go out of business. Today, you're eventually going to go out of business if you take toxic financing, but at least it won't be today. But yeah, they don't take the time to do their homework. They don't analyze. I've seen people sign documents for a toxic lender, that might be 25 or 30 pages, and they never read them. They never have a securities lawyer of their own choosing review the documents. They're so desperate for the money, they just sign it and they get their check, but it's death to the company.
Yeah, that is really scary.
That's just mind-boggling to me. I can't even conceive of somebody signing a document, especially anything over 10 pages, without reading it or having somebody review it for you. That's just nuts. You set yourself up for trouble down the road. Yeah,
and they don't make themselves aware of the trigger points that are in there that trigger defaults.
Exactly.
And then when the default's triggered, the company gets to convert to more shares, and it just goes on and on, because again, they're so desperate for the money, they can't really afford a securities lawyer to review the documents. They're pressed for money, so they're dealing with loan sharks basically.
Yeah, that's a sad thing.
And Mike, once they get onto these exchanges, let's say OTC, for example, what does a company expect to pay to keep your listing alive and to actually stay public?
Good question. OTC Markets charges anywhere from $12,000 a year to $20,000 a year to stay on their service. If you go to NASDAQ charges $5,000 for as a non-refundable application fee, and then when your application is approved, it's $75,000 a year to stay on NASDAQ. And that can fluctuate higher depending on how many shares that you have in the company, how many shares in the float, but normally it's about $75,000. The New York Stock Exchange, I believe, is around $45,000 to $55,000 to stay listed. So again, going public is only one step. You have to be able to have enough money to stay public, to do your filings, do your audits, pay your listing fees, pay your transfer agent, pay your advisors. So it's not just, well, I'm public now that now it's over. The money's going to roll in. Doesn't work that way.
Yeah. No, and plus, no matter how much you want to raise, you have to make sure that you continue to raise that money as you're staying on the markets. That you don't, fall down and your stock goes in the toilet. Well, relatively speaking.
Yeah, because really your ability to raise money as a public company is based on your market cap and the daily trading of your stock, the price and volume and the market cap. Those are critical elements. The market cap is calculated by how many shares of stock you have out times your price. That's your market cap. And companies will invest at a certain percentage of your market cap. In other words, if your market cap is only $5 million and you're trying to raise $15 million, it's not going to work. Nobody invests or puts money into a company more than the company's market cap. So to your point, Vicki, it's a constant element that you've got to take in consideration to keep your trading volume up, your price up, so it's your shareholders benefit, and you can raise capital. Because again, shareholders come into a stock for one reason: they want to make money. They want to buy into your company now. Hopefully, the management will run the company correctly. The stock will appreciate, and they could sell half of their holdings and keep the other half into the market, and then you make a profit and then come back in later on. So not too many investors today adopt the philosophy of buy and hold. They don't buy stocks anymore and hold them for 50 years. It just doesn't happen, especially with small cap stocks.
Yeah.
Well, and the market's so volatile too that you don't have that luxury of buying and holding because of the volatility that's going on, and people don't have patience.
Correct. And most small cap companies, when I talk about small cap, I'm talking about stocks that are $5 or less. In those stocks, people aren't long-term holders of stocks. I mean, They may come in and they might hold for 6 months max. But those, like you said, Vicki, those are volatile areas. So if you come in to a stock at 50 cents and you see it go to $2, you better get out and then wait to see if it pulls back, and then you can come back in. But, again, I'm not a stock trader. I'm not a financial advisor. I don't give financial advice. But what I've done in my personal life is, sell half the holdings when the stock goes up, take a profit. There's no sin in taking a profit. Take some money off the table and sit on the sidelines and see what happens. And that's really the thinking with these small cap OTC stocks.
Yeah, you made such a good point there.
And nobody, even with all of the things that you've just laid out, Mike, nobody considers how truly important it is to actually do marketing for your company, which is a whole nother set of funds that you need to invest in your business so that you can stay on the market and can continue to sell shares and raise capital. It's like a cyclical situation.
Good point. And that's what we do if we through the Reg A model, if we are the investor, we require the clients to set aside 10% of the amount that we write to them. In other words, let's say we write a client a check for $500,000. We require the client to set 10% of that aside for investor relations and marketing that we do. We're not going to invest our money in the company and then let them go out and hire another IR firm or market awareness firm. We're going to handle that internally with ourselves. I've got 25 years experience in IR, PR, and investor marketing to help stocks get liquid and stay liquid and appreciate in price. So if we're going to write a check to somebody for $5 million and we fund it over a 10-month period, they have to set aside 10% of that for marketing, PR, investor relations. So it's not costing them anything. We're giving them the money to operate with, but we just want to make sure they allocate 10% of the money that we fund so we can maintain the liquidity in the stock, because our capital is at risk. We don't want the stock price to drop. The higher the price goes, the more money we make.
You're just protecting your investment to make sure that it works.
Yeah. And, companies don't, if a company decides not to do after we fund them a little bit, we don't fund them anymore. So we're on a transactional basis, so which means we sell our stock on a daily basis through our brokers. We sell a stock that we invest in and get our money back, so that if something goes wrong with the company and they don't follow our advice as far as IR, PR, we just don't fund anymore, because we're not going to risk our capital. We don't take any investments from outside investors. It's strictly our money that our partners that we pool together, and we're not going to risk it if somebody's not going to work with us. We'll work with them, but they have to work with us, and there's no free ride. You made a good point, Vicki. You've got to do marketing of your stock. I'm not talking about, pump and dump and stock promotion. I'm talking about good quality PR, podcast interviews like this, getting on Fox Business TV, issuing quality press releases, going to conferences, talking to people. It all costs money, but it's necessary to maintain your stock price.
And you have to do it consistently, too.
He knows you're out there. How can they invest in you?
Yeah,
that's right. Yeah,
exactly.
Ron, you made a good point. It's got to be consistent. It's got to be weekly, that you're doing something to make your company visible. I mean, a company like Microsoft, Google, Apple, they don't really have to do it. They get so much free publicity from Fox Business and CNBC, the Wall Street Journal, mainstream publications. They get written up all the time. But small companies, they have to compete for shareholders, for investment capital, and the only way to do that is you've got to make the investment community aware that you're out there. Nobody's going to buy a stock they never heard of. Nobody's going to call their broker up and tell them to buy XYZ if they never heard of XYZ. You got to be in front of somebody.
Yeah, that leads into a really good point. One of the last points I want to make on this podcast before we kind of close this out. Mostly we've been talking about this from a issuer perspective, but let's say that I'm an investor right now, and I want to buy some stock in, let's say, a Reg A or whatever it is. How do I know that the company is valuated correctly?
Good point. First off, you need to look at all their SEC filings. You need to look at their 10Qs, 10Ks, 8Ks, all their filings that they're required to file in their financial statements and everything with the SEC, to make sure that what they're filing is correct and not just pie in the sky. Secondly, call the company. I always tell people, look, call the president of the company. If he doesn't take your phone call, then don't invest and don't buy the stock in the open market. If he takes the call, ask him questions. Look, I'm thinking about buying some stock in your company. I want to know, and you don't want to get non-public confidential information. You just want to get the skinny on the deal, how real the company is and what's going on. So again, answer your question. Look at the SEC filings. Look at everything they have to report as required by the SEC. Then call the company. Do, like Vicki always says, do your due diligence. Check the company out. Don't just believe what a press release says.
Yeah, and last question I have for you is the pink sheet listings. What are those?
Yeah, good question. Years ago, I'm talking 25, 30 years ago, brokers used to have these low price stocks over the counters. They would come to their office on pink sheets. pink sheets of paper in a book. That's why they were called pink sheets stocks, because they were all listed. And, it wasn't a quotation system like you have NASDAQ or like you have New York Stock Exchange. In order to get a low-price stock like that, you had to call your broker with the stock symbol. He would take out this pink sheet book, flip through it, and say, the price is this and that, and the broker would give you information. Well, now they don't have pink sheets anymore, the paper. It's all on OTC Markets. So OTC Markets is just a website. It's not an exchange, but it's a website that has the disclosure requirements for pink sheet companies and OTC companies. A pink sheet company is typically one that hasn't filed audited financial statements or all the reports, so they're on the last tier of trading, which is pink. If they've completely full transparency and have filed all their audits and all the reports, they're a QB company. That's okay. Really the difference.
And when I go to look at these listings, sometimes you see a little stop sign there. Does that mean that their stock has stopped trading?
No, what it means is that's something that OTC Markets itself came up with, just to tell people that, look, you want to be cautious, because the reason we put the stop sign is they haven't filed all the reports. They're not filing all the disclosure requirements, so be cautious. So it's a way for them to tell the investors, be careful.
Okay, now if a company is on that little stop sign, would it make sense to think that this is a company that might be a client of yours, perhaps, where they can utilize your funding to get back to where they need to be?
Yeah, good point. Yeah, we're cleaning up a couple of companies right now, trying to get everything removed, trying to get the reports updated, so that we can get them off of that designation and everything. So yes, by all means.
Wow, that's really interesting. You probably have there's your gold mine of prospects right there. There seems to be a lot.
The only drawback to that is usually they don't have any money, and they can't pay us.
They wouldn't be in that position.
Yeah. Some of them, sometimes you find a jewel in there, but other ones, they're just so far gone you really can't do anything about it. But you never know. 1 out of 100 might work out.
Yeah. Well, that's really great information. I'm telling you, this is a gold mine of information for a lot of people who are doing issuing. Mike, how do people get a hold of you? What's the best way to
Yeah, they can call my cell phone, which is 951-236-8473. I'm on LinkedIn. They can look up Michael N. Brette JD on LinkedIn. They can get my profile, and my email address is mikebrette@gmail.com.
Great. And Mike, if you type in Mike Brette and Mappable on Google, we're first page, first listing. And there you go. There's another way people can get a hold of you.
No.
Anyway,
good punch. Yeah. Thank you.
Okay, I couldn't resist that plug.
Sometimes I get so excited I don't think.
Yeah. So Vicki, are you ready to go public? What's going on? Are you ready?
Well, absolutely, because now we know who to go to.
Well, thank you
we
for that.
appreciate that, Mike.
Yeah, I appreciate your kind words, and I appreciate the platform to get me so I can speak.
Absolutely. You're always welcome on. I'm sure we'll have you on again real soon. So, Mike, thanks again for taking the time out to talk to our audience. Appreciate it. Vicki, thanks for co-hosting the podcast as usual. And folks, you're listening to the Mappable USA podcast at mappableusa.com. Just go to that website, scroll down, you'll see our syndication sources. You pick the one you like the best, and you'll never miss another one of our episodes. If you want to be a guest on the show, like Mike was today, there's a guest tab. Just fill that out. We'll see what we can do about getting you on the show. If you like the podcast, if you want to give us a comment, send an email to info@mappableusa.com, or just leave a comment on the page you're listening to this at. And we just want to thank you all for being supportive of our podcast. Thanks for listening. I will be at you next week with another Mappable USA podcast. Have a great week, everyone.